Welcome, everyone. Today, we're going to delve into a topic that is often overlooked but critically important in the world of financial investing: overconfidence and optimism. Overconfidence and optimism can be seductive traits, tempting investors to believe they have a special insight or ability to beat the market. But the reality is, these traits often lead to costly mistakes and poor investment decisions. Let's start by examining why overconfidence is detrimental to financial success. When investors are overconfident, they tend to underestimate risk and overestimate their ability to predict market movements. They may become overly confident in their analysis or investment strategy, leading them to take on excessive risk without fully considering the potential consequences. And when things don't go as planned, overconfident investors may be reluctant to admit their mistakes or adjust their approach, leading to even greater losses. Overconfidence can create a dangerous cycle of overtrading and speculation, where investors chase after high-risk investments in pursuit of unrealistic returns. Studies have shown that overconfidence is widespread among investors, with many believing they can outperform the market through sheer intuition or instinct. We have three different forms of overconfidence that play a significant role in the world of finance and investing: overprecision, overestimate, and overplacement. Let's start with overprecision. This phenomenon occurs when investors have an exaggerated sense of precision when making predictions about market movements and investment returns. For example, they may believe they can predict the exact price movements of a stock or the precise timing of the market, leading to unnecessary risks and losses. Overprecision can give investors a false sense of confidence, making them believe they have more control over the market than they actually do. Now, let's talk about overestimate. This is when investors overestimate their own abilities and knowledge when it comes to making investment decisions. For example, they may believe they are better at selecting winning stocks than the average investor, leading them to take unnecessary risks and overload their portfolio with a few high-risk investments. Overestimate can lead to reckless investments and ignoring important principles of diversification and risk management. Lastly, we have overplacement. This is when investors overestimate their own skills and performance compared to others in the market. For example, they may think they outperform their peers, even if objective measurements show otherwise, leading to overconfident decisions and inappropriate risks. Overplacement can lead to a lack of diversification and an excessive concentration of assets in certain sectors or assets, increasing the risk of losses. Certainly, let's expand on the topic of optimism in investing. Now, let's delve deeper into the concept of optimism. While optimism can indeed be a positive trait in various aspects of life, its implications in the realm of finance and investing can be profound. Optimism, when unchecked, has the potential to cloud judgment and lead investors down a path of irrational decision-making. Optimistic investors often have a tendency to overlook warning signs or underestimate potential risks, driven by an unwavering belief that everything will ultimately turn out for the best. This optimism bias can manifest in various ways, such as maintaining a buy and hold mentality even when faced with mounting evidence that investments are underperforming or overvalued. The danger of this mindset becomes apparent when investors become overly reliant on their optimistic outlook, failing to recognize the need for prudent risk management and diversification. They may neglect to adequately assess and mitigate risks, leaving themselves exposed to significant losses, particularly during market downturns or unexpected events. What's more, this over-reliance on optimism can create a false sense of security, leading investors to become complacent and less responsive to changing market conditions. They may fail to adapt their strategies or take necessary precautions, assuming that their optimistic outlook will carry them through any challenges they may encounter. So, what lessons can we glean from this exploration? It's crucial to recognize that while optimism has its place, unchecked optimism in investing can be perilous. Overconfidence and unwavering optimism are a dangerous combination that can derail even the most well-intentioned investment strategies. As investors, it's imperative to approach the market with humility and a healthy dose of skepticism. By acknowledging our own limitations and staying grounded in reality, we can make more informed and rational investment decisions. It's essential to maintain a balanced perspective, recognizing both the potential opportunities and risks inherent in any investment. Thank you for joining me today on this exploration of optimism in investing. Remember, investing is not a sprint but a marathon. Stay disciplined, stay vigilant, and above all, stay humble. Until next time, take care.